Question 1. Which of the following types of reinsurance agreements is most appropriate for a primary insurer looking to protect against a large unexpected claim on a single policy, such as damage to a specific property caused by a fire or hurricane? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Stop loss reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is a non-proportional form of reinsurance that covers losses exceeding a specified amount. It is specifically designed to protect the primary insurer against large catastrophic losses that go beyond its retained risk. This is different from proportional reinsurance arrangements like quota share and surplus share, which involve the cession of a fixed percentage of premiums. Losses. Excessive loss coverage kicks in after a certain threshold deductible is exceeded, making it ideal for catastrophic events like fires or hurricanes that involve a large-scale loss. Question 2. Mr. Taylor is an insurance broker working with a large insurer that has experienced a series of significant claims during the past 2 years. The insurer is seeking reinsurance coverage to protect itself against future large losses. The insurer prefers a structure that allows it to keep a portion of the premium and loss exposure while transferring a larger share to the reinsurer. What reinsurance structure should Mr. Taylor recommend? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer: B. Surplus share reinsurance. Explanation: surplus share reinsurance is a type of proportional reinsurance where the insurer cedes a portion of each individual policy's premium and losses to the reinsurer based on the capacity or limit of the insurer's retention. In this structure, the primary insurer retains a certain amount of exposure, and any amounts exceeding that are transferred to the reinsurer. This structure allows the insurer to transfer a larger portion of the risk while still retaining a share of the exposure and premium, making it ideal for managing larger losses. This is distinct from quota share, which cedes a fixed percentage of both premium and losses, an excessive loss and non-proportional type focused on large claims. Question 3. A large catastrophe, such as a major hurricane, has caused widespread damage in a region. Reinsurer A, which has a treaty with insurer B, is called upon to share the burden of the claims arising from the disaster. Under which of the following circumstances would insurer B most likely exercise its rights to terminate the reinsurance contract? A. A claim exceeds the retention limit established in the reinsurance agreement. B. Insurer B has experienced consecutive profitable years with no claims. C. The reinsurance contract contains a clause permitting termination after significant natural disaster. D. A dispute arises regarding the loss allocation between the primary insurer and the reinsurer. Answer: C. The reinsurance contract contains a clause permitting termination after significant natural disaster. Explanation: in certain reinsurance contracts, especially those for catastrophic risks, there are specific clauses that allow the primary insurer B to terminate the agreement after a major loss event like a natural disaster. These clauses are typically written into contracts where reinsurers may have significant exposure. Primary insurer may wish to shift or change the terms of their protection after a large loss, while losses above retention limits, answer A, are handled by the reinsurer. Termination due to a specific clause, answer C, can occur as per contract conditions. Disputes over loss allocation, answer D, typically result in negotiations or legal processes, but don't lead to immediate termination unless otherwise specified. Question 4. Which of the following is the primary objective of a quota share reinsurance agreement? A. To protect the primary insurer against losses that exceed a specified amount. B. To allow the reinsurer to assume a fixed percentage of both premiums and losses. C. To ensure the reinsurer covers all losses for a specific policy. D. To allow the insurer to retain all risks up to a certain limit and transfer the rest. Answer: B. To allow the reinsurer to assume a fixed percentage of both premiums and losses. Explanation: quota share reinsurance is a form of proportional reinsurance where the reinsurer assumes a fixed percentage of both premiums and losses for all policies covered by the agreement. This means the primary insurer retains a certain percentage of the risk while the reinsurer takes on an agreed share of both premiums and the associated losses. Non-proportional reinsurance, such as excessive loss, which only covers losses above a certain threshold. Quota share ensures that the reinsurer shares in both the risk and the reward premium. Question 5. Which of the following is a common reason why an insurer would choose facultative reinsurance over treaty reinsurance? A. The insurer needs protection for a large portfolio of policies. B. The insurer wants to automatically cede risks above a certain limit to the reinsurer. C. The insurer needs to reinsure a specific high-risk policy that falls outside their usual underwriting criteria. D. The insurer has a long-term ongoing relationship with the reinsurer. Answer: C. The insurer needs to reinsure a specific high-risk policy that falls outside their usual underwriting criteria. Explanation: facultative reinsurance is a type of reinsurance where the primary insurer selectively cedes individual policies to the reinsurer, typically based on the risk of the policy. This is most often used when an insurer wants to cover a single high-risk policy that falls outside their normal underwriting criteria. Exposure limits: unlike treaty reinsurance, which automatically cedes a portion of all policies that meet the terms of the agreement, facultative reinsurance is negotiated on a case-by-case basis and allows the insurer to transfer specific risks that require additional coverage. Question 6. Which of the following would most likely cause a reinsurance dispute to arise? A. The primary insurer's policyholder has filed a claim that exceeds the retention limit. B. The primary insurer has misreported the number of claims it has underwritten in a given year. C. The reinsurer has failed to pay the full amount of a claim covered under the reinsurance agreement. D. The primary insurer has been able to exceed the agreed upon retention level. Answer: C. The reinsurer has failed to pay the full amount of a claim covered under the reinsurance agreement. Explanation: reinsurance disputes often arise when the terms of the agreement are not followed or when there is disagreement on the extent of coverage. If a reinsurer fails to pay the full amount of a covered claim, this can lead to a dispute between the primary insurer and the reinsurer, especially if the primary insurer believes the reinsurer is obligated to cover the full amount as outlined in the contract. This is a common issue in reinsurance disputes, and the contract terms related to claims settlement would typically govern such scenarios. Other factors like misreporting claims or exceeding retention limits may lead to issues, but are less likely to immediately escalate into disputes unless they involve specific contract violations. Question 7. A reinsurer is concerned about the risk of insolvency from one of its primary insurers in Louisiana, and the reinsurer is considering the implementation of risk-based capital (RBC) for its reinsurance agreements. Which of the following best describes the role of RBC in the reinsurance industry? A. It is a formula used to determine the premium rates for reinsurance contracts. B. It establishes a threshold for the amount of risk that can be assumed by a reinsurer based on its financial capacity. C. It is a measure of the total claims that a reinsurer must pay out in a given year. D. It is a requirement for reinsurers to provide guarantees for all claims payments. Answer: B. It establishes a threshold for the amount of risk that can be assumed by a reinsurer based on its financial capacity. Explanation: risk-based capital (RBC) is a framework used to assess the financial strength and solvency of an insurer or reinsurer. It calculates the minimum amount of capital a reinsurer must hold to support its underwriting activities, considering its risk profile. The RBC formula takes into account like the type and amount of risks the reinsurer has assumed, including underwriting, credit, and operational risks. This helps regulators and reinsurers assess the financial health of the reinsurer and ensures that they maintain sufficient capital to cover their liabilities. It is not used to directly set premium rates or to guarantee claims payments, but it serves to measure the reinsurer's ability to absorb risk. Question 8. In which of the following scenarios would a reinsurer most likely activate a stop-loss reinsurance agreement? A. A single large claim exceeds the retention limit. B. The total claims for the insurer's entire portfolio exceed a predefined threshold. C. The reinsurer has been unable to settle claims within a reasonable time. D. The insurer's premiums for a particular policy exceed a specified percentage of their capital. Answer: B. The total claims for the insurer's entire portfolio exceed a predefined threshold. Explanation: stop-loss reinsurance is a type of non-proportional reinsurance in which the reinsurer agrees to cover the primary insurer's losses once total claims for the entire portfolio reach a certain threshold. The primary insurer retains risk up to this point, and beyond this threshold, the reinsurer assumes responsibility for losses. is for. Reinsurance helps protect against the aggregate impact of losses across a portfolio rather than individual large losses. It's activated when the total claims exceed the agreed threshold, not based on a single large claim or issues related to premiums or claim settlement. Question 9. Which of the following is a key difference between facultative reinsurance and treaty reinsurance? A facultative reinsurance covers a specific policy or risk, while treaty reinsurance automatically applies to all policies within the scope of the agreement. B. Facultative reinsurance involves fixed percentages of premiums, while treaty reinsurance involves variable premium rates. C. Facultative reinsurance applies only to large-scale losses, while treaty reinsurance covers all types of claims. D. Facultative reinsurance is on a risk-sharing agreement, while treaty reinsurance is based on a risk transfer agreement. Answer A. Facultative reinsurance covers a specific policy or risk, while treaty reinsurance automatically applies to all policies within the scope of the agreement. Explanation: facultative reinsurance involves the selective cession of specific policies or risks to a reinsurer based on the insurer's discretion and underwriting criteria. Each policy is negotiated individually between the primary insurer and the reinsurer. On the other hand, treaty reinsurance is a more automatic agreement that applies to all policies that meet the criteria outlined in the treaty, with little to no individual negotiations for each policy. Facultative reinsurance is typically used for high-risk or unusual policies, while treaty reinsurance is used for broader, more systematic risk across the insurer's portfolio. Question 10. When a reinsurer uses loss development factor (LDF) in pricing reinsurance, what is the main purpose of using this factor? A. To calculate the reinsurer's exposure to future catastrophic losses. B. To adjust past losses for the effects of inflation and changes in claims frequency. C. To estimate the amount of reinsurance premium to be charged. D. To determine the reinsurer's solvency based on past claims. Answer B. To adjust past losses for the effects of inflation and changes in claims frequency. Explanation: the loss development factor (LDF) is used by reinsurers and insurers to project future claims based on historical loss data. It helps adjust past loss experience for changes in claims frequency, inflation, and other economic factors. The LDF allows insurers and reinsurers to estimate the ultimate cost of claims that are developing or yet to be reported. This is essential for pricing and reserving purposes, ensuring that adequate capital is set aside to cover these future claims. It does not directly estimate the premium amount or assess solvency based on past claims alone. Question 11. What is the primary purpose of a surplus share reinsurance agreement? A. To limit the amount of premium the primary insurer receives. B. To allow the primary insurer to cede part of its losses once they exceed a specific threshold. C. To allow the primary insurer to cede a fixed percentage of both premiums and losses. D. To enable the reinsurer to share in both the premiums and losses based on a pre-agreed formula. Answer B. To allow the primary insurer to cede part of its losses once they exceed a specific threshold. Explanation: a surplus share reinsurance agreement is a form of proportional reinsurance that allows the primary insurer to cede part of its losses when they exceed a certain threshold. The reinsurer assumes a portion of the risks that exceed this retention limit, sharing both premiums and losses based on an agreed-upon formula. Question 12. Which of the following is a key characteristic of an excessive loss reinsurance agreement? A. The reinsurer shares the risk based on a fixed percentage of premiums. B. The reinsurer only covers losses that exceed a predetermined threshold. C. The reinsurer covers all losses under the agreement regardless of their size. D. The agreement only applies to specific high-risk policies. Answer B. The reinsurer only covers losses that exceed a predetermined threshold. Explanation: excessive loss reinsurance is a type of non-proportional reinsurance where the reinsurer only covers losses that exceed a certain threshold, also known as the attachment point. The primary insurer retains responsibility for all losses up to this point, and the reinsurer covers any additional losses beyond it. Question 13. Which of the following statements best describes the role of a reinsurer in the context of an insurer's risk management strategy? A. Reinsurer's primary role is to increase an insurer's premium income. B. Reinsurer helps to distribute the risks that an insurer may be unable to bear alone. C. Reinsurer's only responsibility is to cover the cost of catastrophic events. D. Reinsurer is responsible for underwriting policies for the insurer. Answer: B. A reinsurer helps to distribute the risks that an insurer may be unable to bear alone. Explanation: the primary role of a reinsurer is to help the insurer manage risk by providing additional financial protection against large or catastrophic losses. Reinsurers share a portion of the insurer's risks, allowing the insurer to remain financially stable while taking on a diverse portfolio of risks. Question 14. What is the primary function of a treaty reinsurance agreement? A. To provide reinsurance for a specific high-risk policy. B. To ensure automatic coverage of all policies written by the primary insurer. C. To limit the exposure of the primary insurer to a single catastrophic event. D. To allow the reinsurer to assume a fixed percentage of specific claims only. Answer: B. To ensure automatic coverage of all policies written by the primary insurer. Explanation: treaty reinsurance is an automatic reinsurance agreement between an insurer and reinsurer. Under this agreement, the reinsurer automatically accepts a certain portion of all policies written by the insurer that meet the terms of the treaty without the need for individual negotiations. Question 15. Which of the following is an example of proportional reinsurance? A. Excessive loss reinsurance. B. Stop loss reinsurance. C. Quota share reinsurance. D. Catastrophic reinsurance. Answer: C. Quota share reinsurance. Explanation: quota share reinsurance is a form of proportional reinsurance where the primary insurer and reinsurer share both premiums and losses in fixed percentages. Both parties assume a proportionate share of the risk and rewards based on the terms of the agreement. Question 16. In the context of reinsurance, what is the retention limit? A. The maximum amount of premium an insurer can cede to a reinsurer. B. The maximum amount of risk an insurer is willing to retain before transferring the excess to the reinsurer. C. The limit on the number of policies an insurer can reinsure in a given year. D. The amount of loss the reinsurer will cover in a catastrophic event. Answer: B. The maximum amount of risk an insurer is willing to retain before transferring the excess to the reinsurer. Explanation: the retention limit refers to the maximum amount of risk or loss that the primary insurer is willing to bear before transferring the remaining risk to the reinsurer. It is a crucial part of the reinsurance arrangement as it determines the point at which the reinsurer begins assuming responsibility for losses. Question 17. Which of the following is true regarding facultative reinsurance? A. It is automatic and applies to all policies within a specific portfolio. B. It allows the primary insurer to cede individual high-risk policies to the reinsurer. C. It requires the reinsurer to cover all claims for a specific portfolio. D. It is used only for small claims that do not exceed the retention limit. Answer: B. It allows the primary insurer to cede individual high-risk policies to the reinsurer. Explanation: facultative reinsurance is a form of reinsurance where the primary insurer selects and negotiates individual high-risk policies for reinsurance coverage. Unlike treaty reinsurance, which automatically covers a portfolio of policies, facultative reinsurance allows flexibility in choosing specific risks to transfer. Reinsurer. Question 18. Which of the following would most likely require the use of catastrophe reinsurance? A. A primary insurer has a large number of small, frequent claims. B. An insurer faces a potential loss from a single, extremely high-value event. C. A primary insurer experiences consistent losses from non-catastrophic events. D. A reinsurer has no exposure to natural disasters. Answer: B. An insurer faces a potential loss from a single, extremely high-value event. Explanation: catastrophe reinsurance is used to cover the risk of a large-scale loss resulting from a single event, such as a natural disaster, that could significantly impact the primary insurer's financial position. This type of reinsurance helps protect the insurer against rare, high-cost events that exceed normal underwriting expectations. Question 19. Which of the following is typically the responsibility of retrocessionaire? A. To provide coverage for specific risks not included in a primary insurer's reinsurance agreement. B. To cede portion of the risk they assume from primary insurer to another reinsurer. C. To provide underwriting services to primary insurers. D. To increase the premiums charged by the primary insurer to cover reinsurance costs. Answer: B. To cede a portion of the risk they assume from a primary insurer to another reinsurer. Explanation: A retrocessionaire is a reinsurer that accepts the risk transferred from another reinsurer through retrocession. This allows the original reinsurer to further share or transfer its own risk to another party, thus further spreading the risk across the reinsurance market. Question 20. In reinsurance, what is meant by retrocessional coverage? A type of facultative reinsurance. B. Reinsurance that provides additional protection for catastrophic losses. C. When a reinsurer transfers part of its risk to another reinsurer. D. Coverage for losses from multiple types of events within the same policy. Answer: C. When a reinsurer transfers part of its risk to another reinsurer. Explanation: retrocessional reinsurance refers to the process where a reinsurer, after assuming risk from a primary insurer, transfers some or all of that risk to another reinsurer. This helps the original reinsurer manage its risk exposure by spreading it further across multiple reinsurers. Question 21. Which of the following is typically included in a reinsurance agreement to ensure that both parties understand their obligations? A claims settlement clause. B. A reinsurance premium clause. C. A retention limit clause. D. All of the above. Answer: D. All of the above. Explanation: a comprehensive reinsurance agreement includes various clauses that clearly define the obligations of both parties. These typically include a claims settlement clause, a reinsurance premium clause, and a retention limit clause, ensuring both parties agree on how claims will be handled, how premiums will be shared, and the level of risk retained by the primary insurer. Question 22. Which of the following best describes a reinsurance pool? A. A form of reinsurance where each insurer in the pool shares the same risks and rewards. B. A specific type of facultative reinsurance agreement between multiple reinsurers. C. A reinsurance agreement that covers only catastrophic events. D. A method of diversifying risks by purchasing multiple reinsurance policies. Answer: A. A form of reinsurance where each insurer in the pool shares the same risks and rewards. Explanation: a reinsurance pool is a collective agreement among several insurers or reinsurers to share specific types of risk, usually for large or high-risk events. The pool allows each member to contribute to the collective risk and share in the rewards or losses based on their participation. Question 23. What is the main advantage of the excessive loss reinsurance for a primary insurer? A. Reduces the premiums the primary insurer pays for coverage. B. It helps the insurer protect against large unexpected losses that exceed a specified threshold. C. It allows the primary insurer to retain all risk below a set amount. D. It applies only to specific high-risk policies. Answer: B. It helps the insurer protect against large unexpected losses that exceed a specified threshold. Explanation: excessive loss reinsurance helps primary insurers protect against the financial impact of large unexpected claims. Once losses exceed a certain threshold, the reinsurer covers the remaining amount, thus protecting the insurer from catastrophic losses. Question 24. Which of the following is a characteristic of a non-proportional reinsurance agreement? A. The reinsurer covers a fixed percentage of premiums and losses. B. The reinsurer only covers losses above a certain threshold. C. The agreement automatically applies to all policies in the insurer's portfolio. D. The reinsurer assumes responsibility for underwriting all policies. Answer: B. The reinsurer only covers losses above a certain threshold. Explanation: non-proportional reinsurance, such as excessive loss reinsurance, involves the reinsurer covering losses that exceed a predetermined threshold. This type of reinsurance helps protect against large claims but does not involve sharing premiums and losses in fixed percentages. Question 25. Which of the following is true about the claims-made reinsurance policy? A. It covers claims made during the policy period, regardless of when the incident occurred. B. It only covers claims made after the policy's expiration date. C. It is not suitable for policies with long-tail claims. D. It covers claims made only for losses occurring during the policy period. Answer: A. It covers claims made during the policy period, regardless of when the incident occurred. Explanation: a claims-made policy covers claims made during the policy period, even if the incident that led to the claim occurred before the policy started. It contrasts with an occurrence-based policy, which covers claims for incidents that occurred during the policy period. Question 26. What is the most common reason for a reinsurance treaty to be terminated? A. A significant change in the insurer's risk profile. B. The reinsurer's failure to pay claims. C. A reduction in premiums by the primary insurer. D. Changes in the regulatory environment. Answer A. A significant change in the insurer's risk profile. Explanation. A reinsurance treaty may be terminated if there is a significant change in the risk profile of the primary insurer, such as a shift in the types or volume of policies written. This could make the terms of the treaty no longer viable, leading to its termination or renegotiation. Question 27. Which of the following best describes the purpose of stop-loss reinsurance? A. It protects the insurer against large, specific claims by providing coverage above a fixed amount. B. It limits the insurer's losses by providing coverage for all claims within a specified range. C. It ensures the reinsurer covers losses only in the case of catastrophic events. D. It transfers a fixed percentage of premium income to the reinsurer. Answer A. It protects the insurer against large, specific claims by providing coverage above a fixed amount. Explanation. Stop-loss reinsurance provides coverage to the insurer for losses that exceed a certain amount within a given period. It acts as a safeguard to prevent an insurer from experiencing excessive losses due to unusually high claims in a particular year. Question 20. What is the key feature of a quota share reinsurance agreement? A. The reinsurer provides coverage only for losses above a specified amount. B. The reinsurer assumes a fixed percentage of premiums and losses for all policies. C. The primary insurer retains the full amount of each claim under the agreement. D. The reinsurer only covers losses resulting from natural disasters. Answer B. The reinsurer assumes a fixed percentage of premiums and losses for all policies. Explanation. In a quota share reinsurance agreement, the reinsurer assumes a fixed percentage of both premiums and losses for all policies written by the primary insurer. This type of proportional reinsurance allows both parties to share risk based on the agreed upon percentage. Question 29. Which type of reinsurance arrangement is most appropriate for an insurer dealing with a specific high-risk policy? A. Treaty reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Stop-loss reinsurance. Answer B. Facultative reinsurance. Explanation. Facultative reinsurance is the most appropriate arrangement when an insurer wants to cede a specific high-risk policy to a reinsurer. It allows the primary insurer to negotiate individual terms for particular policies, unlike treaty reinsurance, which applies automatically to a range of policies. Question 30. Which of the following is an advantage of using reinsurance for an insurer? A. It reduces the insurer's exposure to risk by allowing them to share it with other parties. B. It decreases the cost of premiums for the insurer's customers. C. It increases the insurer's liability without the need for additional capital. D. It ensures that all claims are paid out by the reinsurer, reducing the insurer's workload. Answer A. It reduces the insurer's exposure to risk by allowing them to share it with other parties. Explanation. Reinsurance helps an insurer manage its risk exposure by transferring portion of the risk to reinsurer. This allows the insurer to take on more business without overextending its financial resources and ensures that catastrophic losses do not disproportionately affect the insurer's bottom line.